Hello everyone, my name is Nathaniel Freeman, and this is Freeman's Money. And today we're going to be talking about an exciting topic that most of you are going to sleep through, and that's the stock market and stocks. Now we're going to talk about this because it's a really fundamental thing when it comes to investing. And even if you don't want to invest in the stock market, if you want to take a different route, it's still good for you to know, just so you know what other people are talking about. Now, before we get into it, I'm not a financial advisor. I'm not trained, a professional in any sort of way. I'm a guy doing this himself, and I want to share my knowledge with you guys because I am investing in the stock market, and I think it's a great opportunity for everyone. So, first, what is a stock? Well, a stock is kind of like a piece of a company. So let's say you own your own company, but you want to gain some capital so you can invest in your own company, or like you want to start this new product launch but you need money. So what you're going to do is you're going to take your company and say, okay, I'm going to split the ownership of this company up into a bunch of different pieces, and I'm going to sell those pieces out to people. So let's say you own TD Bank. TD Bank, you cut your ownership into 1 million shares. Now you take half of those for yourself so you can maintain ownership of the company. And then you sell off the other half to people, and based off of their perceived value of your company, they can buy those stocks. So that brings us into another category. What determines stock price? So stock price is determined not by how well the business is doing, not by how much the company makes in revenue, none of those things. It's actually the amount the market is willing to pay for a piece of it. So let me give you an example. If I have a pizza and you're starving, you're willing to give me a higher price for that slice of pizza. So I've got my 8 slices. I'd say, okay, this slice of pizza is $100. If you have a ton of money, but you have no food, you're willing to pay that $100 for that slice of pizza. Now, if you're full, you got a ton of food, and I try to sell you that slice of pizza for $100, you're not going to take it. But if I say, okay, I'll sell it to you for $2, you might be like, oh, well, $2 is okay, I'll buy that. So it's a perceived value based off your situation. It's the same with the stock market. If TD Bank lost all of its assets, or everybody thought it was going to lose all of its assets, and they were like, okay, it's going to be worth nothing like 2 minutes from now, I'm willing to bet people aren't going to pay $100 for that stock. Now, on the other hand, if they think the company's doing fantastic, they're going to go places, everyone's going to want a piece of them, they can probably get away with selling it for a higher price. So a stock is a tiny piece of a company, and the price is determined by what people are willing to pay for it. Now, how do you make money in the stock market? You make money 2 ways. One is based off that growth. So let's say I bought TD at 50, over a year it went up to 100, and I sell it at 100, that means I made $50. Because you got your original 50, you gained $50 when you went up. When you sell, you get that 50 plus your original 50 back. Now the second way is with dividends. Now what a dividend is when a company says, okay, we really like that you guys are owning our company, and we want to reward you for holding on to our stock. So since we've got excess profits this year, we're going to pay you a little bit. So let's say you own TD stock, because we love TD in this video apparently. They should really be paying me for all the mentions of TD, by the way. If you know anyone at TD in advertising, let me know. But let's say TD's at $100, and they'll say, okay, we'll pay $5 a share. That means that each stock is valued at 100, and they're paying $5 out, which means they're paying 5%, which is a very average one in the economy right now for the banking institutes. So what if the stock price drops to 50 because COVID happened? We all saw those stocks drop. Well, that dividend actually stays the same until the company decides to say it or change it. So now when it was 100, you got 5%. When it goes down to 50, you got 10% because it's still $5 you're making, but 50 and 5 is 10 and 105 is 5. Now I know I'm not the best at explaining things, and I know there's so many more details in the stock market, and there's such a long history to the stock market. And I recommend that if you want to learn more about the stock market and just basic bare bones stuff, read A Random Walk Down Wall Street. It's an absolutely fantastic book. It gives you a ton of history, a ton of different methods people have used to analyze stocks. It shows you the flaws in each and the pros in each one. And it gives you a basic idea of what diversification is, what kind of portfolio you should have at what point in your life, and why they recommend index fund investing, like investing in the S&P 500, which I've recommended on this channel a few times. Now, before I send you away, I'm going to mention diversification. Diversification isn't owning a bunch of different stocks. It is, but it isn't. Diversification is when you own a bunch of stocks throughout different areas in the market. So let's say you own one in the financial section, you own one in fast food, you own one in real estate, you own one in the internet, you own Google, you own Amazon, you can own clothing brands, you can own almost anything. You can buy minerals, you can buy, like, there's everything out there, okay? Diversification is when you buy a piece of a large portion of that market or all of that market. You don't have to buy every stock, but you want to be in every field. So if you own 50 stocks and they're all in real estate, you're not diversified because everything you own is still in real estate. You want to spread it out. And Random Walk Down Wall Street, this book right here, it recommends only at least 50 different stocks diversified throughout the economy. Now you can double up and have 2 in real estate or like 2 in home economics. It's up to you, right? But 50 stocks spread out throughout the market, and you want them kind of balanced equally in different sections. Anyways, there's a little detail on stocks. I'll probably give you more information later on, but for now, that should tide you over. My name is Nathaniel Freeman. If you liked the video, smash the like button, subscribe to the channel, and I hope to see you guys next week. Have a great evening.